On July 1st, Dish owed its bondholders $2 billion. On June 30th, the day before the bill came due, Dish filed for bankruptcy. Now, here's the part that makes no sense. The bondholders weren't angry. They'd already agreed to the whole thing in writing 3 months earlier, because this bankruptcy pays them 100 cents on the dollar, in full. Companies don't go bankrupt to pay their debts in full. Bankruptcy is supposed to be where debts go to die, unless the bankruptcy isn't really about the debt. Here's what I think this filing actually is: the last move in a 30-year game. Because Dish, the satellite TV company, was never really a TV company. By the end of this video, you'll see what it actually was and why the man who built it might walk away from this bankruptcy richer than ever. One piece of jargon this week, and it's the whole story. This is a pre-packaged bankruptcy. Plain English question: what if you could file for bankruptcy after everyone already agreed exactly how it ends? That's what this is. Back on March 19th, Dish signed something called a restructuring support agreement with the people it owes money to. Holders of more than 88% of the bonds signed on. The ending was written months ago. The courtroom is just where they film it. And why file on June 30th specifically? Because of that $2 billion bond due July 1st, and because the money to pay it is sitting in a delayed wire transfer. AT&T agreed to buy a chunk of Dish's wireless spectrum for about $23 billion. That deal hit, quote, unforeseen delays. As of this recording, it still hasn't closed. No AT&T money, no bond payment. So the bankruptcy is, functionally, a bridge. A legal waiting room where nobody can collect while a $20 billion check is still in the mail. Which raises the real question: why does a shrinking satellite TV company own $23 billion of wireless spectrum in the first place? Meet Charlie Ergen. Before he built Dish, he reportedly made his living at poker and blackjack tables. Good enough, the story goes, to get shown the door in Vegas. In 1980, he started selling giant satellite dishes off the back of a truck. By the mid-90s, that became Dish Network, and by 2014, it peaked around 14 million subscribers. Then cord-cutting arrived and satellite TV began dying in public. Today, Dish is down to about 6.6 million subscribers. It lost 366,000 in the last quarter alone. One of the fastest melting businesses in America. And here's the thing everyone got wrong for 15 years. They kept asking, how will Dish save its TV business? Wrong question. The TV business didn't need saving. It had a job and it was doing it perfectly. Its job was to spit out billions in cash and to be the respectable, regulated company that could borrow billions more. Because while the TV business melted, Charlie Ergen was buying something else. Airwaves, wireless spectrum, the invisible frequencies your phone runs on. The government licenses them, there's a limited supply, and every carrier needs more. For about 15 years, Ergen quietly assembled one of the most valuable spectrum portfolios in America. Industry tracker Wireless Estimator puts the all-in bet. Spectrum plus the network built on it at roughly $46 billion. The official story was always Dish is building a wireless network, a fourth national carrier to compete with Verizon, AT&T and T-Mobile, a promise the government itself blessed in 2019. And to be fair, he genuinely tried. The network reached 24,000 cell sites. Ergen himself admitted, quote, "It's harder than I thought it was going to be. But here's the beautiful part of the design. Building the network was Plan A. And if Plan A failed, the spectrum itself just kept getting more valuable. Scarce asset, growing demand. The poker player held a hand that won either way. Then last year, the government called the bluff. The FCC said, use this spectrum properly or we take the licenses back. Use it or lose it. And Ergen folded the network and cashed the chips. August 2025, AT&T agrees to buy spectrum for $23 billion. That's the deal, still waiting to close. September 2025, Elon Musk's SpaceX buys more, about $17 billion, half of it paid in SpaceX stock, plus another $2.6 billion, also in stock. Those deals closed, the stock is in hand. Total exit, roughly $42.6 billion against a $46 billion bet. On paper, that looks like a small loss. Hold that thought. The stock is the twist, and it's coming. And one more piece of dark irony hiding in the record. SpaceX itself had petitioned the FCC to crack down on EchoStar's licenses. Musk helped build the pressure that forced Ergen to sell. EchoStar, the parent, not in bankruptcy, has been named the stalking horse bidder for its own subsidiary's remaining assets, with an auction set for August. Ergen filed his subsidiary into bankruptcy and then got in line to buy back the parts he wants, at a floor price he set. And Charlie Ergen himself? His family controls approximately 90% of EchoStar's voting power. The parent is untouched. The $11 billion SpaceX stake is untouched. Fortune says it made EchoStar the single best shareholder return in the entire Fortune 500 this year. And if SpaceX goes public at the valuations being reported, analysts sketch that stake at $30 billion or more. The dying satellite company might be holding its best hand yet. Remember our question from the top. What was Dish, actually? It was a Spectrum warehouse wearing a TV company as a costume, and a prepackaged bankruptcy is how you take the costume off, while a judge holds everyone you owe money to at the door. Now, the fairness beat, because this isn't a cartoon villain story. Bondholders get every dollar. Small vendors get priority. Boost Mobile keeps running. 7.5 million subscribers. The number 4 prepaid carrier in America. A real business, not a rounding error. So did Dish TV and Sling for now. And Ergen really did try to build the network. 24,000 cell sites is not pretend. Nobody in this deal got robbed at gunpoint. But somebody always pays. So who's paying here? You are. Slightly, invisibly, and for years. The 2019 promise was that Dish would become the 4th national carrier. Real competition, lower phone bills. That promise is now officially dead. The network is being decommissioned and the spectrum is going to AT&T and SpaceX. The big get bigger. The tower companies are owed billions with a $2.4 billion window to collect from. 6.5 million satellite TV customers are riding a product with no future, whose owner just told a courtroom its real value was always somewhere else. And here's the market's own verdict. On the news, EchoStar's stock shrugged. AT&T's stock fell. Investors understood immediately who this filing protects and who's now on the hook to close a $23 billion deal. 2 weeks ago, Comcast admitted its media empire was a costume over a broadband business and split itself in two. Today, Dish. Same lesson, terminal version. Don't listen to what a company says it is. Watch where the money actually lives. 30 years ago, a card player started selling TV dishes off a truck. Everyone thought he was building a television company. He was building a claim on the Sky, and now the Sky is being sold for $42 billion, while the television company sits with a bankruptcy judge holding a note that says, everyone gets paid, as soon as AT&T's check clears. Comcast kept the pipes. Ergen sold the Sky. The business you can see is rarely the business. That is the real business model. Next, the $23 billion AT&T check is still in the mail, and what happens to Boost Mobile when it clears is its own story. Subscribe so you don't miss it.